Welcome to the 3 and 10 podcast for Friday, March 13th, 2026. Our timestamp is 4:30 p.m. Eastern Daylight Time. I am your host, Scott Slayton, partner and chief strategist at Capitol Creek Partners. And today, instead of 3 things in 10 minutes, we're going to address one thing in 5 to 7 minutes. Incidentally, I am on the road in Chapel Hill, North Carolina today on the beautiful University of North Carolina campus. And we're going to focus on the war in Iran today. In my opinion, in my analysis, the war in Iran is escalating in severity and elongating in its timeline. I believe that's bearish for risk assets. The current situation reminds me of the early days of the COVID pandemic back in 2020. Complacency seems to reign. I don't understand this. No one around me is bearish. No one around me seems to be scared. And when I talk to my contacts, they almost universally seem to expect this to play out within days or certainly within weeks in a favorable way. But I think slowly reality is leaking into the markets. We have never seen the Hormuz closed. In my almost 40 years as a market practitioner, we've never seen it closed. It was always theoretical until now. It was almost unimaginable until now. But the reality is approximately 15 million barrels of oil per day are not flowing into world markets, and that strikes us as a major event. And the longer this goes on, the more likely it seems that the Hormuz will be closed for longer than most market participants expect. We believe the Iranian strategy is to extend the war to create economic pain for the West. They have proven more effective than most imagined at closing Hormuz. And without U.S. ground forces, the Iranian regime looks increasingly difficult to dislodge from power. Bombs alone are unlikely to get Iran to surrender. So a stalemate could be developing, and we could see oil prices go to $150 or even over $200 a barrel if we do, in fact, get a stalemate that lasts for months. The formula in my mind is pretty simple. Hormuz is closed. Oil prices have to go up to price that reality. Stocks and bonds have to go down, especially non-U.S. assets. They get hurt the worst. Perhaps Asia gets hurt the very worst because they have the least indigenous oil. They have to import almost all their oil. And so this has flipped the narrative from U.S. underperformance to perhaps U.S. outperformance. I think a Trump put is struck around $150 in oil and $6,000 on the S&P 500. The problem is that Iran looks like they're going to decide when the war is over. We can declare victory, leave the Gulf, but that does not open Hormuz. We see no capitulation in the stock market outside of the business development companies or BDCs, alternative asset managers associated with BDCs, and software companies a couple of weeks ago. Our sentiment gauges are not bearish enough yet to be anywhere close to a bottom. The S&P is not even technically oversold yet. There's no major scramble for puts that we see. And the Fed's hands are tied by inflation and the transition from Powell to Warsh. The employment picture would need to deteriorate significantly further from here to see the Fed begin to cut rates, especially with the specter of higher inflation if oil prices continue to move higher. So far, the U.S. consumer has not been spooked. The University of Michigan data were better than I expected this morning. But if consumers stop spending, all bets are off. The odds of a global recession are rising, assuming that the war drags on, and markets are not pricing this scenario. So we go into the weekend more cautious on risk assets, and tactically, we believe we are in the early stages of a global equity correction, which means popular benchmarks go down 10 to 15% from their January highs. As of the close today, the S&P 500 closed at 6632. That's down 5% from late January. So perhaps we're 1/3 of the way there. So do the work, endure the pain of gain, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.